Hi, welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm your host today, Larry Siegel, and my very honored guest is Roger Ibbotson, who is a professor in practice of finance emeritus at Yale and the chairman of Zebra Capital, and possibly best known as the author of the study Stocks, Bonds, Bills, and Inflation, which happened to be the first thing that I worked on when I worked for Roger as an employee of Ibbotson Associates, so 47 or 46 years ago. Roger was my finance professor, and he had the very pleasant habit of hiring his best student who couldn't get a job. And so we're back together. Roger, very glad you could join us today here.
Well, it's great to be back together, Larry. Yes, we did work together quite a bit in the 1970s and 80s and so forth, and then I guess periodically after that. But it's been great to work with you all these years.
Well, thank you. I feel the same way about you. Why don't we start with stocks, bonds, bills, and inflation? What is it, and why did you do that work back in the 70s, and why are you still doing it now, although you had many other accomplishments between here and there?
Well, back in the 60s, we had the capital asset pricing model, and then in the 70s we started having APT and so forth. We had all sorts of interest in risk premiums, and we didn't really have a measure of any risk premium at the time, and so and we had the Fisher and Laurie tapes, Chris tapes, and so forth, but they only went back to 1968. And actually, I was working in the investment office of the university at the time as a PhD student, but I was managing the bond portfolios. But everybody would ask me, when's this data going to get updated? And it never got updated, at least quickly. And so that's what caused Rex Sinkfield and I to actually build the stocks, bonds, bills, and inflation databases. So so not only in the context of this did we update the stock market, because the measure of the stock market was about 10% a year, and it still is about that number. Not only did we update the stock market, but so we wanted to know what the risk premium was. We got the risk-free rate in there, the short-term treasury bills. We got the long-term bonds in there and corporate bonds in there. So we were able to measure the real interest rates, the horizon risk premiums, the equity risk premium, especially, but also even the small cap premium came later. So we were able to look at all these different series and get measures of it. And for a long time, we were the only ones who really had this data. These were total return series because the idea of even computing total returns was actually new at that time. Most people were only computing capital gains, the prices, and then separately reporting the income, but not actually putting the two together.
What would you say is the most important discovery that you made doing in your first stage of putting together stocks, bonds, bills, and inflation?
Well, I think the big discovery is how great equities have done over the long period. And this was from 1926 at that time up through 74, so really 50 years of data, and how well equities have done. And of course, we displayed this in chart form. Actually, can I just show you a chart for a second? I'm not going to go over the chart, but I'm going to put up a chart here. This chart was a very famous chart. I guess we first produced it back in the 1970s, and it showed that a dollar at that roughly 10% growth rate was doubling every 7 years or so. And so it actually grows to some exponentially large number. So if you reinvested all the money and you didn't pay any taxes on it, and you didn't pay the trading costs or whatever, if you follow that chart, if you invested a dollar back in 1926 and held it all the way in time in basically the S&P 500 is basically the 500 largest stocks, the dollar grew to $14,567. So I think the most important surprise for everybody is how much wealth actually can be created in the stock market. Of course, you do have costs and so forth, and you do have taxes to pay and all those sorts of things. But just these kind of raw exponential compounding, the power of exponential growth is just phenomenal, the kind of wealth that potentially can get created in the markets.
Well, I agree. Of course, the trick to it is getting really old. And if you start when you're 16 or 18 with a few $100 and multiply that by the number you just said, you're a millionaire. But most people don't. And I think that the biggest tax is not the government's tax, but the human behavioral one, which is that it's hard to stay invested for that long. If you need the money or there's a crash and you become fearful, you get out and then you miss the big rebound. But most of the good returns come after a crash, I think. So do you suggest that people behave in some particular way in order to capture these returns?
Well, they have to stay in the market the whole period of time and reinvest everything and of course keep their costs and fees down as well. There's no actually alpha in these numbers. These numbers are just investing in the indices, but they do have to really hold for the long term and ultimately, really, the biggest part of this is not consuming because not that many of us got that rich, of course. We basically have consumed the money here. So and that's and so we have a lot of debates about this. And actually, the research foundations have sponsoring debates which you participated in and monitored and so forth.
Yeah.
And those debates they argue that people really wouldn't necessarily achieve those kind of high returns because first of all, the U.S. might is a very special market. It's not. It's actually the best performing of all the large international markets, and so it's perhaps there's a survivorship bias or selection bias in just studying the U.S. But it's not just any old market; it is the largest market. So I think it does have a lot of meaning. I'm not exactly predicting that you can get all that same sort of premium in the future that we've got in the past, but just as a kind of a midpoint, when we actually made these first measurements back in 1974. By the way, we may have to cut. I have to get the lawnmower. I've got a lawnmower guy here. I got to stop him.
Okay.
No.
I got get through the
That was
Sorry.
dramatic. No problem. Bill Sharp had the same problem, but with a dog. And the dog was on TV briefly for a while here, and he was chasing him off. It was very funny.
So I don't know, where do you want to start again here?
I'll go back to like one thought, one sentence, and start with what you.
Let's see. I guess I was talking about how it's difficult to you might not get this in the future. Oh yeah. Okay. Let me start off. So you might not actually get the same kind of equity risk premium in the future as you have in the past, but it is interesting to note that when we did this study back in 1974, if you look at the 50 years prior and the last 50 years, actually the last 50 years were just as good or a little bit better than the prior 50 years. So I think these history is definitely a guide to what's going to happen in the future. And so I maybe it isn't the complete guide because the future isn't the past exactly, but I think you can learn a lot about the future by looking at the past.
I agree, and I'm just wondering if the future of that starts today is starting with the S&P around 5,400, which is not only an all-time high. The market hits all-time highs all the time, but it's very high relative to the earnings of the S&P. In 1974, it was low. So maybe the last 50 years were better because of differences in valuation at the beginning and the end, and that the underlying trend may actually be the same, but just by picking the endpoints carefully, you can get differences. Do you?
I'll accept that comment, Larry. And in fact, it's kind of interesting because in 1974, when we first came out with this, it was right it was in the recession period, and people were scared. And here we basically made forecasts of the market. We said that we said you could extrapolate as a possible way of making a forecast, and people were. It was so interesting to people that it actually made some headlines in some newspapers at the time, because nobody else was talking bullish about the market. I was looking back 50 years. Other people were looking back 2 years.
2 years, right? Yeah. And I was trying to get through college by selling some of the stocks that my grandfather had given me, and they were worth less than he paid for them. But I did make it. So as time went on, you made a very successful business out of what seemed to be the thinnest reed of a business idea, which is taking the study and commercializing it in some way. Can you spend a minute or two? I do want to move on to some other things, but that was an important part of my life as well as yours. And of course, when you sold the company, you did get rich, as I think it's something you had always wanted to do. So tell a little bit about yourself here.
Well, actually, the stocks, bonds, bills, and inflation certainly put me on the map, I guess. But also we had Ibbotson. I had a lot of interest in lots of consulting that came from that, and that's what caused me to start Ibbotson Associates. And actually, Larry was our first employee at the time, and so that's what caused the company to start. It's also later on I joined the board of Dimensional Fund Advisors with my co-author Rex Sinkfield, and that had a lot to do with the start of Dimensional Fund Advisors too. So I've been on the board of that. Now I'm retired from that, but I was on the board for 40 years. So a lot of there's so much interest in learning the basic facts about what markets have done and what the payoffs for risk were, that it actually became a big part of my life, and it actually was the impetus to start Ibbotson Associates and a lot of other activities that I was involved in.
Well, I'm going to circle back to SBBI, stocks, bonds, bills, and inflation, right at the end, because you're doing something else on that now. Let's move on to the idea of asset allocation. And sometime in the 80s, Gary Brinson and I believe you and some other people did maybe it was just him, did a study of how much of the return to an investor comes from asset allocation versus security selection and other factors. I should thank Gary, by the way, for endowing the chair in which I'm sitting, not this physical chair, but the mental chair. I'm the Gary Brinson Director of Research. And what was the study about, and was it right? Is it wrong? Are we understanding their conclusions properly?
Well, we were always interested in asset allocation. Stocks, bonds, bills, and inflation, by its very nature, was cutting across asset classes. And Gary Brinson and his co-authors, Biebauer, and he had two different articles, one by Brian Singer and one with Randy Hood. So, but the Brinson studies said that 90% of the variation of returns can be explained by your long-term policy asset allocation. And that was technically correct, but totally misinterpreted and maybe somewhat misleading. First of all, what people immediately said is 90% of your return from some asset allocation. It turns out that the asset allocation policy pretty much describes all of your return. Often, if you don't have an alpha, it's 100% of your return. So the real answer is that asset allocation explains 100% of your return. Now that's true.
the return.
That's the return, and the Brinson studies didn't say, they said the variation of return. People misinterpreted it and just said the return. So almost everybody misinterpreted it. But even if we're talking about the variation of returns, the 90% is misleading because the starting point is not zero. It's really about 80% or really north of 80%, because if you regress your return of your portfolio on the stock index, just one index, you're going to be over 80% typically. If you regress your portfolio on returns on my portfolio, you'll still get over 80% because all our portfolios are so correlated with each other. So if you're talking about 90%, your starting line is 80%. And that's why the idea of, we had a 40, 90, 100, and we had another couple other studies I've done with co-authors that say it was 50% of the return. Roughly half of the difference between your return and my return has to do with asset allocation, and the other half has to do with our timing and our selection of the different securities and so forth. So it's more like half, or 40% or half, that comes from asset allocation policy. And that's because the starting point is not zero, it's 80, and 90 is halfway to 100, essentially. So it takes maybe a little bit of a knowledge of math to get into this, to really understand it deeply. But the ultimate answer is, if you're interested in what percentage of the return came from asset allocation, and the answer is 100%. If you're interested in the question is, how does your portfolio differ from mine across different samples, it's about 50%.
And for those who want to pursue this further, you can send me an email and I will send you a link to a wonderful paper called Does Asset Allocation Explain 40, 90, or 100% of return or of performance, by Rogers and my colleague Paul Kaplan. It won the Graham and Dodd Award from the Financial Analyst Journal, and it gives an answer in a very understandable fashion. Roger, over the period where you were developing both these risk premium measures and the apportionment of return or relative return between asset allocation and security selection, your work went in a different direction. And it was what I would call the supply and demand for capital market returns. It is, in fact, that became the title. But usually people think of that in terms of the supply and demand for capital. If you turn the rock around and look at the back and think of it as the supply and demand for returns, it helps you think more clearly about what's going on in markets where we're investing capital in the markets in order to get that return. What is the basis of this new thread of thinking, and where have you taken it since the first work in 1984?
Yeah, actually, Larry, you were a co-author along with Jeff Dearmeyer at the time, of those two supply and demand papers.
I was.
And I guess all my life I've written lots of papers on the demand or the supply. They're separate papers, but on the demand or supply of capital market returns. And on the demand side, that's really developed. I've done a number of articles with Tom Zurich and with Paul Kaplan again, and James Shong. There have been at Morningstar. I've done a number of articles on popularity. In fact, what are the articles? What are the key articles? Actually, one of the key works was actually a monograph, the CFA monograph.
For the Research Foundation, yes.
Yes, and that's called Popularity, a bridge between classical and behavioral finance. So what we're doing is we're saying, what do people like? What do people dislike? And if you have given a set of expected cash flows, how much will you pay for it? If you really like the form that it's in, say it's very liquid, then you might pay more for it. If you really dislike the form that it's in, that it's very risky, you'll pay less for it. So people like liquidity. They like brands. They dislike risk. They dislike risk, especially they dislike all types of risk, whether it's interest rate risk or the equity risk. But they also especially dislike the tail risk. So the things that people dislike, you're going to get at a lower price. But when you lower the price, you're getting a higher expected return. And if you think you like something like ESG, you're going to have to pay more for it. And if you pay more for it, you're going to get a long-term, typically a lower return. So ultimately, this is a model. It's a capital asset pricing model. We call it a popularity asset pricing model, actually. And we've written a number of articles, including one coming out. There's two forthcoming articles. One of them in the Journal of Investment Management, comparing the CAPM APT and the PAPM, the Popularity Asset Pricing Model, and another one in the Journal of Portfolio Management about domesticating the factor zoo, comparing that some of the returns are related to attribution factors. They have a lot of impact on the factors in any given period, but they aren't necessarily the long-term pricing factors. They have to distinguish between the long-term pricing factors and the attribution factors.
But what are attribution factors, Roger?
Well, they might be the industry that you should invest in, or they might be a currency or something. There might be something specific that you might be able to predict, and you might be able to get an alpha from it if you can predict it well. But they aren't necessarily something that produces a long-run return. And we're particularly interested in these pricing factors that produce a long-run return, because this is what ties everything in finance together. You look at from the investor's perspective, they're looking at their expected returns. So the return the expected return of a security is particularly important because it impacts the expected return for investors. Of course, that's their long-term expected return. But it's also the cost of capital. It figures into the cost of capital when you figure the stocks and bonds as the weighted average cost of capital, and then also it's also the discount rate used in valuation. So this long-term rate is very important, but there's also the attribution rate, all these attribution factors, and even the pricing factors that can change quickly over time that cause valuations to change. So there's a long-term valuation, but there's also all these attribution factors that can change things quickly in the short run, and certainly overwhelm anything that's happening in the long run.
Well, certainly one of the short-term, I don't know if you want to call it a factor, one of the short-term phenomena is if a stock or an attribute of a stock goes from unpopular to popular, you get a huge return. And it may make it look as though that's some sort of a return for the risk taken or a fundamental property of the security, and people are going to project it forward forever, and that's exactly the wrong thing to do. Because once it has reached its level of popularity, whatever it's going to reach, then the return is lower going forward.
Yes.
Did you make that point in your work, or do you think that that's something you should reiterate now?
I can definitely reiterate it, but I definitely make that point in our work too. Okay. Certainly that the as something becomes more popular, it becomes more valuable, and the price shoots up. If something becomes less popular, the price shoots down. On the other hand, the pricing model is how popular you are at the level here. When something is highly popular or overly popular, we say we'll have low long-term returns. but it could get more popular. And if it gets more popular in the short run, it's going to have super returns. Anything that gets more popular has a big increase in price, and you'll have a very high return from it.
Well, let's turn the rock back around and look at the supply of returns. But what does it mean to say that there's a supply side to capital market returns? Because most people don't talk that way, but I know you and I have, and since you're the guest, you get to say what it means.
Well, think of it as the valuation model has a numerator and the denominator. And the numerator are the cash flows. The denominator is what you discount them at. So the demand side is how much you like something and what you kind of discount it at. But on the supply side is what is very important, what the cash flows are going to be. And those cash flows can link to all sorts of things. We can look at it from an earnings perspective, from a dividends perspective, from a economy perspective, looking at the cash flows of the whole economy, the GDP, and all these things can be tied together. And we have various papers that have tied these things together. So the supply side is what does the economy supply? And of course, that has a lot to do with what the return of the market's going to be. The return of the market is both related to what the economy supplies and on the demand side, how we're going to price it.
Well, on the supply side, I remember Jeff Diermeyer around 1984. He was at that time the top guy other than Gary Brinson at Brinson Partners, said that the hypothetical upper limit of the long-term rate of return is the growth of the economy plus whatever cash flow the company spins off, because if the price of the company grows faster than the economy forever, it'll take over, become the whole economy, and there won't be any room left over for any other companies. We know that can't happen. So that, let's say the economy grows at real 3, the stock prices should also grow at real 3, but that's just the price. And then dividends and any other cash the company throws off is in addition to that. But would you say that's a good summary of the supply model?
That is a good summary. And the key is the growth rate. The growth rate is only part of the answer, so that it isn't the real GDP is what you expect from the stock market. The stock market is throwing off a lot of income, and the economy is throwing off a lot of income. It's the sum of the income and the growth of the income that give the valuation. And actually, this led to one of the big distortions with people looking at the dividend discount model. And the dividend discount model is based on the Gordon model, which says the return is equal to the dividend yield plus the dividend growth rate. Well, the distortion is that many people started looking at the dividend yields, which have been dropping dramatically. And of course, because they've been dropping dramatically, the dividend growth rates have been very low. But there's a reason for this. The reason why the dividends have been dropping is really since about 1980, the buybacks have been prevalent, basically, and they've been replacing dividends. And so actually, if you think of the total payout, and this is work that I've done with Philip Straw more recently and so forth, if you look at the total payouts, they're about the same. They're 4 to 5% the same, but there's a huge shift from dividends to buybacks as far as how the cash is being paid out of corporations. And once you recognize that, now the income is high again if you're actually participating in these buyouts, and the growth rate is high because the growth rate of the total payouts is high. So you should look at it from a different perspective here. And there's a lot of reasons why buybacks have replaced dividends. One of the major reasons was most of this time dividends are taxed much heavier than buybacks. And you can also, but a lot of other reasons, corporations can control when they pay out their cash rather than having to meet last year's dividend rate. And corporations have big benefit to control this, and individuals can also control when they receive their dividends or their payouts now, because they can decide whether to take the buyout or not to take out the buyout. So I think this is a permanent shift that's taking place, but it's caused some people to be confused about what payouts mean.
And the confusion continues. Something that I'm doing for the Research Foundation with Paul McCaffrey is to go through the 330 emails that pass between the various participants in a video that you and I did with several other people a few months ago, and make and write it up to see what all these different thinkers were saying about dividends versus buybacks versus other means of getting cash to the investor, which brought in Rob Arnott, who I think you and he have been disagreeing for a long time, and wrote some letters in the Financial Analyst Journal. He doesn't think that the buybacks should be counted the way that you're counting them. What is he talking about? And if you care to...
Well, the way we're doing everything is consistent with Miller and Modigliani, basically. We're saying dividends don't really matter, and the payouts don't really matter. I mean, there may be some tax effects and so forth, but in efficient capital markets, it doesn't matter whether you took the dividend or didn't take the dividend. You could sell before you got the dividend, or whether you participated in the buyback or whether you didn't. We're doing everything in the context of dividends or buybacks. They don't matter. Because they don't
matter to the total return. Yeah,
they don't affect the total return. That's why they don't matter. They may affect what's capital gain and what's income, but they don't affect the total return. Rob, I can't even begin to describe what Rob believes. He believes some sort of dilution is taking place, but that's the bad mathematics, because we're staying with the standard Miller and Modigliani perspective on everything we're doing here. So the dividends don't matter, buybacks don't matter. But if you want to measure a return as an income plus a growth in income, you have to do it from the total measure here. You can't just use the dividend part of it, which is now a minority part of the payout, and say, oh, that's falling. That isn't even growing anymore. But in fact, if you look at the total payouts, you actually get very good measures. In fact, in our paper with Philip Strauss, we actually have what we call CATY, C-A-T-Y, cumulative cyclically adjusted total payouts. And
CATY is cyclically adjusted total yield, isn't it?
Total yield, yes.
Yeah.
And actually that measure, if you take the 10-year cyclically adjusted number, you get it actually has more predictability than Bob Shiller's CAPE ratio.
Yes, it does. I actually wrote that up on a paper that was never published, probably because I gave it a very strange name. It was She Caught the Katy and Left Me a Mule to Ride. Now, only people who watched the movie The Blues Brothers will have any idea what I'm talking about, but that was a lyric from one of the blues songs in the movie, and it refers to the Katy Railroad, not the cyclically adjusted total yield. But if you want a copy of the paper, which I actually think is worth reading, just email me and I'll send it to you. That goes for the audience, not just you, Roger. I want to bring this back to what you are doing on stocks, bonds, bills, and inflation right now, because, first of all, the 50th anniversary of your work has arrived. It was first 1974. This is 2024, and it's also coming up as the 100th anniversary of the first data point in your study, so 1926. And in 2026, the Research Foundation hopes to publish, in fact, has committed to publish, the century edition of Stocks, Bonds, Bills, and Inflation. And apparently you've got some challenges to get that done. What are you doing? And if you don't mind talking about it, what are the challenges?
Well, I sold Ibbotson Associates to Morningstar back in 2006, and but part of the sale was the stocks, bonds, bills, and inflation. And to Morningstar's credit, they really kept that going for the last 15 plus years or so. And but Morningstar is looks like they're dropping the series eventually, and I have to rebuild them. So I'm in the process of rebuilding the stocks, bonds, bills, and inflation series. I think they have particular importance because it is the 100th anniversary coming up. It's also they've been a guide to people looking at their asset allocation, a guide to looking at what the risk premiums have been and the various risk premiums of the market, the equity risk premium, the horizon risk premium, the small cap premium, the real interest rates, the default risk premiums. This has been a guide for how people think about the long run. And so I think it's very important to have these series continue. They'll have to be rebuilt, and I'm in the process of rebuilding them right now.
Well, sounds great, and I look forward to working on that if that happens to be how things work out. At any rate, the Research Foundation, beyond just me, has agreed to publish that. So we're going to really look forward to you getting done, and maybe I'll have a role in that. Who knows? I would like to turn in these last 10 or 15 minutes to a topic that you brought up that is kind of orthogonal, like way out in left field, to most of the work that you've done, and that's biology. You gave a great presentation on it that's somewhere on YouTube. I want to know, first of all, what is the general thrust of your thinking, and then I'll have some follow-up questions.
Well, let me say, first of all, it is about biology and it's about Darwinism, but I don't think of it as totally in left field. I've always been interested in the long run, and maybe this is much longer run, of course, but and I've always been interested in demographics, because I think demographics are one of the most important things about long run investing and so forth. So when you're interested in demographics in the long run, this obviously led me. The starting point is Darwinism, and I have a paper it's not published yet, but it's called Darwin. I guess I have to look at the date. Yeah, The End of Darwinism: How Humans Are Overriding Evolution. And one of the major point, a starting point is for humans. Humans themselves are overriding their own evolution, and not necessarily in a positive way. Because let me say, I think it's all positive, but the impact of our genetics is not necessarily positive. Since about 1800, we've had a dramatic change in child mortality. You go back to over a couple hundred years ago, people would have 7 children and 2 or 3 of them would survive. Now, from a Darwinian perspective, this is the natural way, because what Darwin's perspective is we have statistical survival rates. The next generation that we have, whatever species we're talking about, the next generation is not better adapted than the parent generation, because if you make mutations and variations in the genetics and the parents were already adapted, the offspring are less adapted on average. But the key that makes Darwin work is that only the more adaptable survive. Roughly, we call it the survival of the fittest. That's not quite right, but survival of the most adaptable. But if only the most adaptable survive, and you only have a minority of the most adaptable survive, each generation becomes more adaptable than the last generation. And but humans have broken the chain here, because all our children are surviving right now. Actually, in the whole world, about 95% of our children survive. We've gone from less than 50% surviving to 95% of our children surviving. And when all our children survive, we're not genetically improving anymore because it's no longer survival of the most adaptable. Everybody's surviving. And ultimately, we are really genetically decaying at a very slow rate, but genetically decaying. I don't consider this bad, though. It's really great that our children survive. It's terrible to lose a child. We really want our children to survive. We may not be genetically getting better off, but we're still improving because we're economically improving. We are culturally improving. Our technology is growing much faster than any slight decay in our genetics, and every generation is actually far more adaptable than the last generation. But it's not genetics anymore. It's really cultural adaptation and technological adaptation.
Well, that's a very powerful argument. It's going to annoy some people, but it's still right. And I was wondering what you plan to do with this idea other than talk about it on a video.
Well, I think it's something we want to recognize, and ultimately, though, the other aspect of it is it isn't just over. We're not just overriding humans; we're overriding all kinds of our plants and animals. We've domesticated mammals for the most part. 94% of the biomass of mammals on the earth is actually domesticated. It's basically cattle and pigs and humans and so forth. The squirrels and tigers, they make up less than 5% of the biomass of mammals. We haven't affected some of the other wildlife quite as much, not all the plants, but we've done a tremendous amount of domesticating plants. There's nothing Darwinian about the way we grow our crops today. There's nothing Darwinian about the way we raise our animals because they're artificially inseminated for the most part. We choose which ones want to survive and which we don't, and so forth. So all sorts of things like that case. And then when you go even to the wild kingdom, we have huge impacts because with our climate change and habitat destruction and herbicides and pesticides and so forth, we're having tremendous impacts on the whole biomass, really. But I will say there are parts of biomass that we haven't affected so much, and they're mainly the lower order species like bacteria or single-celled species and things like that. Those things are still definitely most of the biomass is still following Darwin, but not the biomass that I think that we're most interested in.
That's very interesting. What it makes me think is that we had better continue to push really hard to improve our cultural and technological environment because our genetic environment is going the wrong way. And, even if it's very slow, if you go forward 800,000 years, which H.G. Wells did in the Time Machine, and we had separated into two species, the Eloi and the Morlocks. The Eloi were completely useless. The Morlocks did all the work, but they kind of looked like something from 2 million years. They looked like apes from 2 million years ago. The very long-term consequences of non-Darwinian evolution could be very strange.
Well, I don't want to make those long-run calculations yet. I mean, I do think that evolution is a very slow process, and who knows what might happen with our technology 100 years from now. We might be able to control our genetics to be better off, not worse off, and so forth. So I'm not saying we're always going to be worse off, and we're so much better off with every generation, actually, because the economy is actually growing much faster. Like the population exploded as soon as we had as soon as we cut down the mortality rates. We went from 1 billion in 1800 to 8 billion today. Now the fertility rates are dropping, but they've especially dropped since 1970. Actually, they were the fertility rate for the world in 1970 was 4.8. Now it's 2.3. So we've had a clear drop, but we're still above the break-even 2.1. It's the developed countries that are way below. They actually have we would think too low fertility rates. They're averaging more like 1.5 or 1.6 or so fertility rates. But I think we have to dramatically cut the fertility rates in Africa and the Middle East, but those are way above 4. And
Well, I tend to agree because I'm not one of them. But I think that fertility rates have dropped in less developed countries much more than we expected, and maybe more than we were aware of. I mean, China is kind of developed, but it's losing population right now. It's not. It's so far below 2. It may be closer to 1. India is just right at replacement rate. I think 2.1, and that between China and India, that's 2/5 of the world. So, yeah, sub-Saharan Africa and parts of the Middle East are growing very fast, and that means that the balance of population in the world is shifting in favor of them. But I'm not sure what that means. It's just
I think what it means is that they cannot develop. If you can't invest, if you have so many children that you can't invest much in each one, I think in order for Africa to develop, it has to, just like China really developed when it cut its fertility rates. Africa can potentially do the same thing, but it won't be able to develop much without cutting its fertility rates. Now, I don't know, there's a cause and effect here. As you start developing, you automatically cut your fertility rates, but lowering your fertility rates also helps you develop. Let me say, I recognize that from an environmental perspective, it's not Africa that's causing the major environmental problems. It's the developed world, because our environmental footprint is so much larger. On the other hand, long term, with the high fertility rates, Africa might become the problem.
Well, I think that's right. My book, Fewer, Richer, Greener, which I wrote in 2019, goes into some detail on that. And I'm writing another book, which is a sequel to that, where I'll have more to say. I'm not sure what it's going to say yet, but it is certainly going to take account of the decline in fertility. Africa is making some progress. It is slower than you might hope for from a development point of view, but it is the very highest fertility rates are long gone, and the very best in the sense of having the lower fertility rates, countries in Africa are about where East Asia was 35 years ago. And
Africa is making progress, and I'm just saying that this kind of progress is necessary for the economic development of Africa.
Yes, it is. And there's something else that's necessary for the economic development of Africa, which is that they need more capitalism. They've got capitalism on a small scale. People are free generally to make and sell whatever they're capable of making and selling. But I think a lot of our development in the developed world came from large organizations that pay well. So do you see that happening in Africa?
I think that capitalism is definitely the ultimate seed of success. But I got to say, mixed with women's empowerment generally, when women are empowered to basically kind of have what kind of children they want, then that combination of capitalism and women's empowerment, and I don't mean crony capitalism. That's
not capitalism. That's right.
A lot of these dictatorships basically have crony capitalism, where from the top down they decide what would be the appropriate use of resources and which company should do it and so forth, and you end up with oligopolies of various sorts, and not even the best entities surviving, basically. So I think that capitalism is very similar to Darwinism. Basically, you do want the the most adaptable to survive. And actually, I have a variation of the paper I've talked about called Darwin, Darwin, Malthus, and Schumpeter, and how basically this creative destruction goes on with capitalism that keeps on replacing something with something better. But that doesn't happen in a dictatorial perspective. It has to happen from the bottom up. And these economies that are now, so many of them around the world, are run by dictators. These basically lead to crony capitalism, which is not a good method to. I'm actually quite pessimistic about China, actually, going long term forward. I think got a lot of momentum there, but they're moving away from capitalism into crony capitalism.
Well, that concerns me too, although it's hard for me to argue with a system. I have all kinds of problems with the way that people are treated in China and that sort of thing, but it is the largest creation of wealth in the history of the human race.
It's been tremendously successful, but it's basically has relied on capitalism to get there, and it looks like it's moving away from China's moving away from that at the moment.
Or at least Xi Jinping is. Yes, that's right.
And I will say, what top-down economy does do well is build infrastructure. And it's good at fighting wars, too, because you don't have to have the population behind you so much. You can force everything from the top down. So if you're fighting wars or building infrastructure during those stages of development, the kind of the dictatorships can be very effective. But during later stages of development, when bottom-up capitalism is certainly the best method for long-term potential.
I couldn't agree more. I hope that China sees the light here, because they did once. I mean, the changes between 1976 and 2014 are unlike anything we've ever seen in the world. The U.S. is more developed. It took us 250 years. I don't know if you have an answer to this, but as we kind of move toward a close here, what countries would you be most bullish on now? And I'm thinking not in 800,000 years, but let's say 25 years, the time horizon of a person in middle age who's looking forward to retirement, person who's 48 and wants to retire at 73.
Well, we're going, let me say, I think humans are adapting through all these technological and cultural ways. I am actually very optimistic about, I'm actually much more optimistic about humans than what we might be doing to the other species. So I will say,
you're eating them, so I get your point.
So humans are getting richer and richer and richer. Economies are growing much, much faster than population's growing. Even in the historic, huge population growth periods, like from 1800 to the present, the population grew at 1% a year. The economies are growing at like 2.5% a year. So they're getting an extra 1.5% of real growth, which really adds up over time, grows exponentially. So I'm very optimistic about the human race and where we're headed. Now we're going to get richer and richer and richer, and pull everybody out of poverty. And I think we'll pull out. I think Africa will pull out of poverty too, as it. But I did name some reasons that they have to change in order to get there. But I think I'm optimistic about the whole world actually. As far as in the very short run, places like Singapore, which can grab off the displacement of the mismanagement of the countries around it, I think I'm really surged. But so I don't have. It's not so easy for me to name too many players at this point that are going to really surge, though, in the short run.
Yeah, I can't really name that many. A few years ago, I was saying, well, we never really thought that Taiwan Israel and Estonia would be the leading countries in anything, but they are in technology.
Well,
And
Taiwan is the technological powerhouse of China, but of course there's all the disputes of how Taiwan should be run, which is run from the bottom up in a capitalistic way, versus China, which is not. So so Hong Kong was the key capital market and the reach and the door to the West. Yeah. Um, and Taiwan is the technological center of China in so many ways. But I'm afraid that China is kind of not exactly helping the case with their strengths here.
are you excited about India?
India's going through a lot of rapid changes. I think it's definitely, yeah, I would bet on India definitely longer term here. I don't know how long, but I mean, they're
I don't
just
know
enough
how
to work
long, but
through.
if you use Google Street View and you just wander around some of the streets of the major cities, it looks like nothing that anyone has ever seen in India before. The middle class is just huge and lives in apartment blocks that look as good as anything that better than anything you have in China because they have different design values, but it looks more like a conventional emerging market rather than a country full of desperately poor people with almost nothing to eat. So,
Yeah, I think India's got a fine future. Uh, you're going to see some of the growth that China had in
yeah.
India.
Anything you would like to, you're the kind of thinker who's thought about every topic in the world. So maybe I should just ask you to sum up what you want people to take away from this discussion beyond what you've already said, ideas that haven't yet been raised but that are on your mind, and then we'll call it a day.
Well, I let me say, I am a long-term thinker. That's why I got interested in Darwinism, you know, and I try to look at things in a broad perspective. That's why I really built stocks, bonds, bills, and inflation data sets to begin with, because the big kind of picture stuff of what's happening in our economy and overall markets, not just the stock market, but the bond markets and inflation and so forth, what's happening across the thing, and looking at, I try to look at as long term as possible across time. So I'm interested in data, and I'm interested in data, and I'm interested in looking across centuries of data and so forth, and across broad kinds of markets, and I'm interested in the whole global environment here, where how humans interact with all the other species as well too. Because I wouldn't necessarily call myself a humanist, because I'm really interested in the whole set of species, and I think if humans have dominated too much here, there's a problem with how we're impacting the other species here. So I'm, but I do think we're moving in the right direction on that, and I, I, I all the countries of the world, actually, I mean, we're having too much dictatorships, no question about it, and that's going to hurt a lot of economies around the world and so forth. But but I believe in capitalism, and I believe in data, and I believe in markets, and so I guess I'm not done with my career, I guess, because I'm pursuing these things in all the ways that I can.
Well, I think that that's an admirable way to spend your not lack of retirement. You've also helped a lot of people save for retirement by having good asset allocation practices and policies, and now you're not going to retire. So there. Nate, we're done. So you can play the thing if you want. And thank you, Roger, very much for your very wide-ranging thinking across time, space, and even species. Hope to catch up with you again soon. For the CFA Institute Research Foundation, this is Larry Siegel, and have a great rest of your day.
For more information, please visit rpc.cfainstitute.org/research-foundation.